So hello everyone and welcome to another episode of the What the Finance podcast. And on today's episode, I'm happy to be hosting Alex Morris, who's also known as, it's the science of hitting, I think, or TSOH. So Alex is a long-term investor and former buy-side equity analyst with 10 years of industry experience. Most recently as part of a 4-person investment team responsible for allocating $1.2 billion in client assets. And I think in April 2021, you started the Science of Hitting investment research service with the goal of providing complete transparency for your research process. So Alex, thanks again for joining the podcast. And just on to my first question. I'll sort of go back to like one of your first articles, which I think it's one of the free ones, so anyone could have access to it. And it's sort of called Returns and Lessons Learned. And you talk about the investment failures and sort of how they've really shaped your philosophy today. So maybe can you talk about these failures and sort of what really changed your investment outlook?
Yeah, well, first of all, thanks for having me. And we're recording this in March 2022, so it's almost been a year since I launched, and the time has certainly flown by. And I write an article every Monday and every other Thursday. So going back to that one I wrote in April 2021 is many articles ago. So I'll do my best to remember what I even wrote about. But yeah, I thought it was really important right out front when I launched the service to be, a big selling point for what I'm doing is transparency and being very open and honest about who I am as an investor and also the outcomes from my investments. So I wrote Returns and Lessons Learned to kind of show the places where I had, failed in the past or had bad outcomes, and how those experiences kind of shaped who I am or who I, continue to evolve towards being. I think the ideas I specifically called out in that article, a notable one is JCPenney, which for those who don't know is an old mall-based retailer in the U.S. And the company went through a rough patch as we came out of the financial crisis. And long story short, Bill Ackman got involved, very well-known investor. People who don't know who he is, put out one of his famous, 400-page slide decks where he broke down every facet of the business that he thought was important. And I think what really happened to me on that investment and where I think it provided important learnings was, one, I was just too quick to kind of fall back on the work that he'd done as opposed to forming my own thesis, as opposed to forming my own unbiased conviction. The second part of that is, I think if I had really taken a step back at that time and thought about where the world was going and how people are shopping, I mean, you don't even have to talk about e-commerce, basically. JCPenney had been losing retail share in brick and mortar for many, many, many years. So I think it was fairly obvious that what JCPenney was not where the world was going. If their plans had worked, maybe they could have changed that, but it was a massive hurdle to make that happen. And in hindsight, maybe the biggest lesson of all as an investor was, and I think I see younger investors do this a lot, and it's something I did a lot as well. I was very, very slow to see that the thesis had changed and to kind of admit defeat. So I think that's something I think about a lot more now is kind of how do I lay markers at the outset for what a failed investment will look like. And it can be really hard to do that in real time because you have to differentiate between noise and what truly matters. But I think when you start seeing crumbs, you start seeing red flags that are concerning to you. I've learned to be a little bit quicker in terms of the business results, not in terms of stock prices or things like that. But I've learned to be quicker in terms of reacting to those red flags.
Yeah, it's really interesting. I think, I'm going to go back to that article. I think it's that article, maybe another one that you've posted on your website. It's at the time of my investment, sort of each company had already lost some of its standing in the eyes of the customers relative to the competition. So that's sort of what you're mentioning there, where they'd already had this downward spiral. They weren't doing well compared to other competitors. So even though it might be undervalued, they're still not that good company that you really want to be investing in.
Yes, that's exactly right. And I think, you might contrast it with something like Microsoft, which I've held it for over a decade, and it's been one of my best performing stocks by a pretty wide margin. And I think there are some parallels with that situation, at least in the, call it 2010, 2011, 2012 time period with that idea. So, it's not always black or white. I think the key insight there, I've said previously that, Microsoft in 2012 was at $25 a share or whatever. A few years later, it was at $50 a share. I think it was actually a better investment a few years later than it was when I made the investment, because it started to become clear that a change in management was starting to lead to an internal change in focus and culture, and the numbers were starting to bear out that reality. And I think that's what you really need to see if you're going to bet on situations that, have somewhat of a turnaround feel to them.
Yeah, it's interesting. So you get, rather than maybe being the same management, you get a new management, and then you see sort of a massive change or shift in sort of how they position themselves or how they work.
And then a massive difference as well. I mean, I think that's spot on. Another massive difference as well, obviously, is that Microsoft's business, while it may have been trending in the wrong direction in some ways, was in a much, much stronger position than a JCPenney or a Kraft Heinz was at that comparable tough spot. So what it required from a managerial perspective, the bar was just so much higher. And, in the case of, Kraft Heinz is still a little bit up in the air, but in the case of both those companies, it's proven to be a very difficult challenge to kind of reposition your business, reposition how customers see you in their head. It's just a very difficult thing to do.
Yeah, definitely. So if you look back and maybe, who's really influenced your style of investing? I think you've mentioned Warren Buffett in the past. Is there anyone else who you'd say that, they've influenced how you invest?
Yeah, Warren Buffett and Charlie Munger are the two main ones, and they're really how my education started, probably 15 years ago now. They gave me the right frame of mind just at the highest level of thinking about businesses and not stock prices. And that's something that's so incredibly important to have ingrained in your mind from the outset, in my opinion. Peter Lynch was another massive influence early on. I always recommend his books when people say, hey, I don't know anything about investing. How do I get started? I think he does a great job of showing how, this investing can seem like something where it's really requires a ton of intelligence and some skill set that the average person doesn't have. And I think he shows that a lot of that is kind of a misnomer. You're really just trying to find very well-run businesses that are going to be able to grow over long periods of time that you can buy at reasonably attractive prices. That second part scares people a little bit, but it's not as much, it's not as much calculus as you might think. It's a lot more basic arithmetic. So Peter Lynch is another massive one. And, then in later years, as I became a bit more experienced, Chuck Ockrey's been another massive influence of mine. His firm has a very straightforward approach in terms of what they're looking for, and they make long-term bets, and they do so with high conviction in terms of their position sizing. So their style and implementation of how they think about investments is very much aligned with what I'm trying to do.
Yeah, because I've sort of looked, you share your, portfolio, and a lot of it's, I guess you look at maybe, Warren Buffett and Berkshire Hathaway, it's very much, value, classic value, whereas you've got like the mix of, I guess, value as well as maybe more of the, technology stocks. So is that sort of where that influence came from, and just being able to analyze those companies?
Yeah, it's really, it's just being open-minded and thinking about the opportunity set that appeals to you, the things that you're capable of understanding. And, unsurprisingly, I'm in my early 30s, and Warren Buffett is now north of 90 years old. I'm pretty sure. I forgot. But so what we think about and what we're drawn to is obviously quite different. I don't really bucket things too much in terms of growth versus value, but I do think there's a lot to be said for businesses that are in a position for structural growth, because it has such an impact on value creation, the internal culture, management's incentives, et cetera, et cetera. So it's hugely beneficial in my mind to be in businesses that have the support of, call it at least mid-single digits top line growth.
Yeah, definitely. That's super interesting. And, you mentioned before how you're always looking at these companies, making sure that, I guess, your idea hasn't changed, or sort of your beliefs haven't changed. So has there been an example of, I guess you mentioned that there with JP, the company that you mentioned before, but has there been another, like, more recent example where you just realized that, I maybe got this wrong, or something's changed in the markets where, maybe that investment, the idea isn't the same as it was before?
Let me think. Curate's a unique example. Are you familiar with Curate or no?
No, I haven't heard of it.
So Curate is basically at the highest level, it's a TV-based retail business. You watch a channel on TV, and if you're interested in a product, you can call in or go online to buy the product. I got invested in the company largely because of a special situation that was happening, but I ended up owning the stock, and it was something I could see myself owning for the long term if I thought the numbers justified doing so. I think it's a fairly good business at the end of the day. Granted, it's going through a pretty significant change as pay TV, most notably in the US, is undergoing a massive transition. That's an example where I saw the numbers turning in a way that I thought was discouraging. I thought it was starting to imply that some of the benefit that they'd received from COVID, when people were stuck inside their homes and watching a lot of TV, I thought the numbers were starting to show that benefit was potentially fading. And if that happened, I thought it would be a very important event for the business and a pretty big negative. So that was a situation where, and again, it's a unique one given that it was a special situation to start with, but that was a situation where one quarter of a few discouraging data points was enough for me to say, I'm out of this entirely. That doesn't happen nearly as often for my call it normal positions, because they tend to be much more long-term just in how they're initiated and how I'm thinking about owning them. But I do think about it in a very similar way. As you start seeing discouraging data points, whether it's in terms of, customer churn or gross ads, pricing, whatever it may be, I think you have to be thoughtful about how to, bucket them. And it's certainly an art and not a science. And I think you can also get tripped up as you marry that data with what the stock price may be implying. So it's certainly not the easiest thing to do, but I've seen enough examples now where when the fundamentals start to turn against you, it might be best to exit the position, live to fight another day, and you can always revisit the situation if you think it merits doing so.
Yeah, it's interesting. So you said it was on the back of one earnings. Was that mainly because of the industry it was in? And as you said, there's like quite a lot of disruption to that business model. So we already maybe had thoughts previously that you weren't sure about it?
Yeah, that's a very fair point. It was a situation, the business had already been, flatlining might even be a generous interpretation. It was certainly struggling to grow, and it was facing pretty massive headwinds. And pay TV in the US is unique relative to other parts of the world, but the pay TV business here is undergoing massive change. And there's a scenario where linear pay TV kind of blows up. And if that happens, it'd be very bad for Curate, at least in the short term. So I always had those lingering thoughts in the back of my mind. And to your point, I think that partly led me to pull the trigger more quickly here than I may in other situations.
Yeah, definitely. And you mentioned before that, you've had this influence of being quite concentrated in your portfolio, maybe compared to other people. And, it's quite contrary to a lot of people I've interviewed who are all about, diversification and protecting your portfolio. But sort of why, other than, I guess, the influence from other investors, why have you decided to be a bit more concentrated?
Yeah, it's funny. Concentration is an interesting thing because it a lot of it just comes down to how you think about investing and what you're trying to do. Charlie Munger said at the DJCO meeting the other day, I think he said, if you own 4 businesses, you're already sufficiently diversified or too diversified. He may have said, which is, but that's how I really think about it. I mean, again, I've owned Microsoft for over a decade. I've owned Berkshire Hathaway for over a decade. These are companies that I own, and my outcomes on those positions will ultimately be dependent upon, the returns of the business. I'm not too worried about either of those positions going through a period where the stock price goes down 10, 20, 30%. I mean, with Microsoft, that basically has happened here recently. But it doesn't bother me in any sort of way because I know the company has a very strong balance sheet. I know it has very good management. If anything, I think periods like this are probably a net positive because it gives them the opportunity to look at things that may not be available when, the air is calm. A good example is Activision Blizzard, which Microsoft has a proposed acquisition for. And that was more company specific issues than what's happening in the world at large. But it's a good example of how a management team that's prepared with a balance sheet that's, strong can do things when opportunities arise, and whether or not the stock goes down in the short term is really going to have no impact on Microsoft's future.
Yeah, definitely. And I guess, there's the big five tech companies have just got so much cash and they're in such good positions, aren't they? I guess it's just finding which ones are the best to invest in, really, and the timing of it.
Yeah, it'll be interesting to see. I mean, it certainly seems that the regulatory environment has started to change. I mean, it's really notable for a company like Facebook, which is even now struggling to get a deal done over in Europe. That's, a couple $100 million, an immaterial deal. It seems that regulators are changing their posture on big tech M&A or large company M&A in general. We'll see if Activision Blizzard gets done. Even if it does, I'd be curious, a very similar deal 2 to 3 years from now, if that will get done. So that'll be a massive change in how these companies think about their capital allocation. And obviously it'll probably lend itself to more repurchases, dividends, whatever it may be.
Yeah, definitely. And as you said, they've just had I guess Berkshire Hathaway's the same, just had all this cash and it's trying to find ways to utilize that. And I think Microsoft has bought multiple gaming companies and, but as you said, there's getting to the point where I guess we're going to be going away from these big conglomerates and maybe breaking them up or potential or, other things that could try and reduce their power.
Yeah, we'll see. It's very interesting. It's funny how maybe not for those companies as much as some of the smaller players, but especially in tech land. But it's funny how a 20, 30, 50% decline in your stock price can cause the conversations among investors to shift pretty meaningfully, along with their views on those businesses. It's funny to see how that works.
Yeah, I think you look at, obviously, Facebook Meta is the prime example at the moment, isn't it? It's like massive drop. And, you look at the company and you could say they might not have the future growth, but they're still making a bucket load of money and they've still got a position, cash position. So it's fascinating.
Yeah, that's an interesting one because there's unquestionably some changes under the surface in terms of the business, primarily as a result of IDFA. But yeah, even there, IDFA is a somewhat quantifiable impact, and it's just funny to see how the market's view on the business, on management, et cetera, can shift aggressively and call it a 6 to 12 month period. But that's investing, and that's where back to your question on conviction and large position sizes and having a relatively small number of positions. For me, that's something that is important also in terms of truly understanding these businesses and following them closely and being comfortable living through drawdowns. I think you have 100 positions, you just can't follow them as closely as you can if you have 10 positions. And it makes it a lot harder to build conviction and to live through the rough patches. And it also makes it harder to really know whether you should continue to have that conviction and stick through the rough patch. If you don't really understand the business, it's very difficult to be a long-term investor with individual positions, in my opinion.
Yeah, and some of these companies are so large and they have so many aspects of, the businesses that could have big impacts on obviously the stock, but also the future potential. So it's trying to understand everything to do with that.
Absolutely.
And because you could say like not just the last few months because of obviously the conflict in Europe, but also I feel like the past few months it's been very frothy, the market, and small pieces of data have had massive impact on I guess the price and other things. I'm not sure if you have an opinion on that, and why do you think it's so volatile? Like we've seen it with Meta, Snapchat, other companies as well.
Yeah, it's always hard to say. I think investing, I think this is a Seth Klarman quote, this idea of balancing humility and conviction. I'm not the kind of person who just stands there and goes, well, this is dumb. The market shouldn't be down. This is all short-term noise. I think that's a bit, and that's something I probably would have said 10 years ago, by the way. I think that's a little bit of a too arrogant of a perspective. I think it's okay to think in that way and to be open to the idea that this is a good opportunity to be aggressive. But I think you also need to, in some ways, listen to what the market, what other investors are thinking or saying. Can you repeat the second part of the question again? I'm sorry.
I think it was saying, why do you think it's becoming a bit more frothy and the market are more volatile and, is just the exogenous external factors, or do you think there's something else with it? Yeah.
Yeah, I think it's, it's the normal uncertainty of the world. It's funny. I was looking back at something I wrote in March of 2020, and for me at least, these things drop out of my memory so quickly. The opening to that article was, I'm writing this after the close on, I think it was March 18th. The market was down 5% today. It's down 30% in the past 6 weeks. That was the opening to the article. And it's funny, I kind of blocked out of my memory that happened. Obviously, I knew the market went down a lot during the heart of the pandemic, but and the remainder of the article is basically saying, the government needs to step up and recognize that businesses and individuals are going to basically go bankrupt if there's no offsetting help for what we're about to go through. And it's just a good reminder that how insanely scary that period really was in hindsight. And now you look 2 years later, there's obviously been bumps along the way, but the world collectively has kind of navigated their way through it. I just think that's always the reality in investing. But in the periods where the uncertainty becomes more apparent and the risks, you can start going down the road of what does this snowball into, and you can usually pretty reasonably get to a scenario that looks very, very bad. So it's understandable that people become a bit more nervous as they think about what that means for their investments. I think the smarter way to approach it is to have yourself always aware of the fact that there's uncertainty in the world and that stock prices can go down a lot, and to position yourself accordingly, preferably beforehand. But that's the way to address it. It's not to spend your days running around trying to foresee these things, because in my mind, that's basically an impossible thing to do.
Yeah, definitely. So as you said, just being prepared I guess, internally about yourself and understanding your portfolio and your companies as well as you can, and maybe the impacts this could have and sort of small things in that way. Maybe not impacts in the short term, but impacts in the long term on your actual, investment thoughts on it.
Yeah, and coming out of the investment advisory business, out of that world, a big part of thinking about financial planning and portfolio construction is ability and willingness to bear risk. And, you need to have a portfolio, an asset allocation that accounts for how you'll react to a 20, 30, 50% drawdown. And again, you're not going to predict these things when they come, and they will come. They happen infrequently, but these things do happen. So you need to set up your life and your investments in a way that you can live through volatility, because if you can't, you shouldn't be owning equities is really the answer.
Yeah, and it seems to be happening a bit more the last few years. So it's even more important than, I guess, the 10 years prior to be mindful of that.
Yeah.
Yeah, definitely. And so if we sort of look at, as we mentioned before, very concentrated portfolio, just making sure that you understand these sort of specific companies. So I'm not too sure. Is there any sort of, what's your thoughts on the direction, or you don't even think about the direction? Your focus is just analyzing these specific companies and how they work.
Yeah, it's really that second way of thinking. And, depending on the company you own, stock prices do have an impact on potentially the way people are thinking internally, right? If you're a Spotify or even a Microsoft, companies like that have a lot more internal exposure to stock options and things like that which impact the way employees think about being part of the organization. So the impact of stock price movement on stakeholders is a very real consideration, even if a company has a strong enough balance sheet to weather any storm. So those things are worth thinking about, or at least being cognizant of. But I really think about addressing this problem from being partnered with companies and with management teams that are always focused on the long term. They're not pushing things so far that they put themselves in a position where even a temporary rough patch could be a big negative. Coming back to Curate, and again, I keep reiterating, but it was somewhat of a special situation. It was very unique for how I typically operate. But I think there's a fair argument in some ways that company has fallen victim to that risk. I think they've probably ran the business a little bit too aggressively in terms of financing. And I think there's probably a legitimate argument that they have not been as forward-looking in terms of investing to evolve the business as a result of that factor. And, when you go through things that are your fault or not your fault, just exogenous impacts, that can make things really scary. So more and more, I just find myself leaning towards companies that are not exposed to those kind of risks. And that doesn't mean the stock price won't go down, but I can sit here and be very comfortable with the portfolio that I own, regardless of if the market's down 20% in the past 6 months or up 20% in the past 6 months.
Yeah, and you think about, obviously interest rates going up. I guess this is looking outside. It is even more important to make sure that these companies' balance sheets are okay, not too much debt. There's maybe growth, still making money. It's even more important.
Yeah, absolutely. Yeah, I try to. The article I wrote today is, or the article I put out today is called Volatility and Portfolio Construction. And the big part of the article is basically this question I've been kicking around in my own head over the past few weeks, which is, where's the point, if any, where it makes sense to give up the benefits of a thoughtfully diversified portfolio to reallocate to positions that presumably have higher expected rates of return as they've done very poorly. And, not to spoil the article, but I think a big part of it is being really patient and always thinking long term and recognizing the role of a position within a portfolio, as opposed to just thinking about a position in terms of what's my IRR on this one stock. You have to marry those two ideas, and there's puts and takes in doing so. It's not all benefit, but I think if you're truly focused on the long term and you're talking about, this isn't play money. The portfolio I show to subscribers is every dollar of invested assets that I have. So this isn't a joke. I mean, it's really my savings. So, that part of the portfolio construction process, I think, is a lot more important than, you might give it credit for when you first start investing.
Yeah, and what are some types of, roles in your portfolio and diversification? Like, what is it, like maybe the compounders, the growth stock? Is that sort of how you look at it, the high growth potential?
Yeah, I think about it more they might be bucketed in that way as well. So that may be fair. I think about it a little bit more in terms of kind of like the industries that they're in, or the attributes that they have as it relates to things like you mentioned, interest rate exposure. So I own financials where I think that if we ultimately move into a rate environment that's more aligned with what we thought was normal before the last 10 years, I think over the long term, those companies benefit from that development. So an example like that. Another example, the company I own, Dollar General, which is basically thousands of rural grocery stores throughout the United States. It's a business that, even in a period during a recession or, with things going on all around the world, that business just keeps coming. And, at least in the intrinsic value part of it all is what's most important. But there's also the potential benefit that the stock price of a company like that will perform well during a period where other parts of the market may be doing very poorly. So, it's kind of like at that level. I certainly think about it mostly in terms of how the business and the profitability will be impacted. But if there's positions that also help from a stock price perspective, that's surely a nice cherry on top.
Yeah, I guess you could say that in the next, few months, we might see a few of those, maybe cheaper stock prices for some really good companies.
Yeah. And to the point of the article, it's an interesting question to think through. I don't think it's a one size fit all answer for every investor, but it's an important one to understand and think about. And it also plays into this idea of position sizing and how you think about what you do in your portfolio, which, as I allude to in the article, I think it's funny. I've been at this for a long time, but it's one of those things I think I've been a little bit too arbitrary in terms of how I have thought about position sizing. I certainly don't think it's a science, but I think there's an opportunity for me to be a bit more deliberate in how I do it. So that's something I'm going to hopefully be exploring here in the next couple of months.
Yeah, it's interesting. So what you think, you just were a bit random with your current portfolio, sizing? Or
it's, in theory, you sit down and you look at everything and you go, this has an 18.5% IRR and this one has a 16% IRR. I'm going to position, weight this one X% higher. And I think there's a lot of false precision in that. And I honestly don't think it's not accounting for all the variables that matter if you're doing it that way. Again, it's an idea I need to think about a lot more. There's a great podcast with Sean Standard Stockton of Ensemble Capital. He went on Bill Brewster's podcast, The Business Brew, and he talked about this question of position sizing and how they've systematized it a little bit more internally. And I think his idea on what he's talking about there, I don't know the exact implementation, but the way he talked about it to me is a very thoughtful and intelligent way to start doing it. So I'll try to find my own version of that or copy it directly if they've made it public. We'll see.
Yeah, definitely try and find it. It's always the best way to do it, isn't it? Just find what you can and copy as much of it. So
copying smart people is a good way to go.
Yeah, definitely. I was actually going to ask, sort of, what is the best piece of advice that you've been given, I guess, in investing or just in general?
I'll probably go back to what I said earlier, this idea of really thinking about equity ownership as partial ownership of a business, something that's to be held for the long term. You know, in the shareholder letter this year, Warren Buffett talks a lot about this idea of, and the section titled Banks, he talks about this idea of really creating a company that has business partners in terms of its stockholders, not just a bunch of random people who are trading it because they're trying to get a 10 or 20% pop. And that way of thinking about investments to me is, it just seems rare. And I think a lot of people do things in their portfolio where they have a bucket that they kind of think about like that, but then they also have other things they're doing in there that are more short term or are more gambling, like, in my opinion, whether it's, you know, things with options and the like. And I think it's easy to trick yourself into thinking that those things are not getting in the way, that they're not impacting how you think about stocks generally. But I think it may do that more so than some people give it credit for. So I really try to push everything that's not long-term equity ownership, thinking about the quality of the business, et cetera. I try to push everything that's not that off my radar, and, you know, hopefully it works.
And how do you find, I guess, analyzing new companies? How do you fit that into, you know, understanding all the other companies as well?
So it certainly helps if they're operating in an industry that I think I have some understanding of. You know, my general process is I have an Excel kind of template that I've built over time where I'll go through and plug in all the key income statement data, KPIs, et cetera, going back, you know, generally as long as I can get data for, at least 10 years, hopefully 20. And I like seeing that visually in terms of the progression of the business over a long period of time. And it gives you some sense for, hey, is this, you know, a steady 3, 4, 5% grower? Is this a cyclical business with big ups and big downs? How have the KPIs changed over time? What is management focused on? Things like that. Then I kind of marry that with, I'll go back and read, if they're shareholder letters, I'll go back and read as many as I can read. If they've had an investor day, I'll go review that. So I'll look at all that kind of information, and I'm really trying to build a mosaic in my head of who is this management team? What are they focused on? Has their focus changed over time? When things went badly, were they transparent with shareholders? Those kind of things. So I'm just really trying to get a sense for the people that I potentially may partner with. The last step of everything is really the valuation part, because the first filter I'm really trying to get through is whether or not I want to own / have this on the watch list at all. And a lot of things don't make it past that filter. So if a company gets past that filter, that's when I start thinking about, okay, you know, what's the valuation look like? How does this compare to the opportunity cost of everything else within the portfolio, et cetera?
Yeah, it's really interesting because I think I saw something where retail traders, they normally spend, I think 60% only spend a day before they invest in the stock. So obviously that would probably take a bit longer. How long do you think on average it would take for you to do that?
It's difficult to say because there's tons of things that I watch in a way and that I have been watching for a long period of time, but where, you know, the level of deliberate focus and really knocking out a deep dive, it just depends kind of. So Chipotle is an example. I've owned it before, but I've probably followed it for, I'd say, over 5 years now. And I don't really have a marker in the ground in terms of where I'd consider buying it, at least not yet. I'm working on a deep dive right now. But that's a name where if I spent a week on it, I could buy it tomorrow if I thought the price was right. But I haven't been following it for a week. I've been following it for like 5 years. So it's hard to say. There's nothing that I look at where after 2-3 days I go, okay, I'm making this a big position. That just doesn't really happen for me. I need more time than that. I need more familiarity with the history of the business and really, again, the people I'm partnering with. For me, that's such an incredibly important part of what I'm doing. And, you know, I do the work on the front end so that when things happen on the back end, I I can be comfortable with the fact that I've essentially given management the leash to operate the business, to make capital allocation decisions as they see fit. I'm entrusting them to run the business. I'm not going to sit here and nitpick everything they do. If I felt the need to do that, I'd rather not own the stock.
Yeah, definitely. But it's just making sure that the overall, movement that they're pushing forward is the right one that you want in your portfolio.
Yeah, and I think to some extent it's giving them the leash to make those decisions, and also giving them the leash to make mistakes, by the way. I mean, those things do happen, but if you think you're partnering with someone who is focused on the right things, has the right incentives, and also has a vision that makes sense to you, I kind of step back a little bit and let them just do their thing and see how that shakes out. And obviously, if I start to question that at a high level, then that's a problem. But generally speaking, these things don't shift very quickly.
Yeah, definitely. It's just taking your time. And I guess I know for myself, when I was just, even a few years ago, I was very impatient. You're always trying to, analyze as quickly as possible or just find out that best stock. And do you think that's something that's happened to you as well, that over time that you've become more patient and just, wait a little bit longer?
Absolutely. I mean, it impacts everything. It impacts where you start your search. I mean, there's a lot of people will run a stock screen and sort it by, the PE or free cash flow yield, whatever it may be. That's fine, but it's just not the way I think about it anymore. My starting objective is not to find what's cheapest on whatever quantifiable measure. It's to find people that I want to partner with for long periods of time and to find really good businesses, and then to figure out whether or not the equity is valued at a price where I think I'll achieve sufficient returns over the long run. But it just completely impacts everything that you look at and how you think about making investment decisions.
Yeah, definitely. It's a big decision. It's not something that you can just, as you said, not something you just want to sell out of straight away. You want to spend lots of time analyzing it, and at the same time on the other side, if you're selling it, you want to analyze it as well.
Yeah. And it's all, the other nice thing about that approach, in my opinion, is that it makes the knowledge all very cumulative. So, I've followed retail names like Walmart, Costco, Dollar General, Dollar Tree for a very long period of time. I think I have a good understanding of where they all fit within the ecosystem, what their competitive dynamics are, what their advantages and disadvantages are. It makes it very easy to make a decision on one of those handful of names when something happens that, for someone who has not followed them closely, they probably just won't have the same historical context on what this means for the business. So, I bought Dollar General, I think it was last year. It's just a name where I feel incredibly comfortable with what they're focused on and what their long-term objectives are. And I just don't know, you don't get the same thing when you're screening based on valuation, in my opinion.
Yeah, I think that's, I don't know if it was you or maybe somewhere else I read it. It's like, the amount of risk you want to take, it's all based on if you can sleep at night and if you feel comfortable with what's in your portfolio, even when, the volatility we've seen over the past few weeks.
Yeah, or you just, or you just commit to being a completely different type of investor or really market participant. You can be someone who, has stop losses on their positions, whatever it may be. That's not the approach that makes sense to me. But if somebody wants to approach these things in a different way, then they probably have very different objectives, or at least thoughts on how they're going to get there.
Yeah, well, you look at, so many amazing investors like Buffett, like I guess you could say Cathie Wood's done quite well up until recently, maybe even, Druckenmiller, and they all just have their own different, unique ways of doing it. So there's no right or wrong.
Yeah, that's probably one of my favorite articles that I wrote as part of the service is from a Druckenmiller speech where he talks about this idea of comparing someone like himself to, a Buffett, and their approaches are very different in a lot of ways, but he talks about the ways that they're similar to some extent. And one of the big points he made was when they see something that they really like, they bet it big because those opportunities are pretty rare. And that's something that really stuck with me. I think that's probably, regardless if you get the same approach to thinking about businesses and investments as I do, I really think that point is key. When you see a mispriced bet, given the opportunity set that you're looking at, you have to bet it, and you have to bet it big. If not, then, what are you truly trying to do at the end of the day?
Yeah, I think that's massive. So Alex, thanks again for joining the podcast. And I guess my last question was, what was one message you want people to take away from this? Or was it about betting big, or is there something else?
Well, I think given where we're at in the market right now, there's been a ton of volatility lately. And, a lot of the companies that I like thinking about talking to younger investors, people like myself. I mean, now I'm still learning, obviously, but myself 5 to 10 years ago. And this has been a good learning period in terms of thinking about the companies you're investing in and what it truly means to own a stock for the long term. And, especially when you place bets that at a high level look very similar. I use this kind of descriptor in today's article, these young innovative companies with a lot of growth, but where the steady state economics are somewhat unproven. You learn that things like that, when the world gets really ugly, they trade very similarly. So, if you're nursing a big loss in your portfolio right now, but you're younger, consider it, a tuition, consider it a cost of learning about investing, and, continue to focus on the long term and truly think about what businesses are worth owning and why. And if you keep that perspective, I think a period like this will just be a positive at the end of the day.
Yeah, and I think you could say this recent period has probably been the first time in the last 15 years or so where you've really been punished for maybe not overanalyzing and making sure that you're in these right companies.
Yeah, I mean, we'll see how long it lasts. Every period preceding this, at least as far as I can remember over that period, seems to have been, fairly, very short-lived. Even in early 2020, I think we were basically out of that hole in a few months, if I'm not mistaken. So we'll see if this lasts longer and if it gets worse. But even if that's the case, I honestly think it's for the best long term, because it'll provide a better education than what you get in just a crazy bull market.
Yeah, definitely. So I guess, as you said, it's a fool's errand trying to predict. So we just strap in, and we're in for the ride. So Alex, thanks again for joining the podcast. Yeah. And I know you're on Twitter, and we've mentioned before the science of hitting, as well as your website. And you have a newsletter that people can buy if they want to sort of read every single article. Is there anywhere else that people can see your work?
Yeah, those are the main places: Twitter @TSOH_investing. And then, TSOH Investment Research Service. As you said before, I worked in the industry for about a decade. Now I just take all the work that I did as my day-to-day job and make it available to subscribers. And anytime I make changes in my portfolio, I disclose those changes beforehand with an explanation for what I'm doing and why. So you have complete transparency into everything that I'm doing as an analyst and as an investor.
Yeah, great. Awesome. I'll put that all in the description below. So Alex, thanks again for joining me.
Thank you very much.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.